My name is Nicholas DeCamplin, and today I will be discussing the Great Recession of 2008 to 2009. We will be developing an understanding of what were the causes that led to this recession, the government's responses to this crisis, how this recession changed our economy, and how we should prepare for the next recession that our country faces. The Great Recession of 2008-2009 dramatically impacted our economy. The Great Recession started in December 2007. From that time until the event's end, GDP declined by 4.3%, and the unemployment rate approached 10%. During 2008, housing prices were falling, default rates were increasing, and the confidence of both the consumers and investors were deteriorating. These conditions were reinforced by sharply rising prices of crude oil, which pushed gasoline prices to more than $4 per gallon during the first half of the year. Against this background, the stock market took a huge tumble. The S&P 500 index of the stock prices fell by 55% between October of 2007 and March 2009. This collapse eroded the wealth and endangered the retirement savings of many Americans. No one could have predicted the market would drop and cause our economy to face difficult times. However, we will discuss the causes that led to these devastating times, analyze the fiscal and monetary policies utilized, how this changed our economy, and ways to prepare if something like this were to happen again in the future. Government intervention is necessary in times of uncertainty and hardships within a country. Policymakers contribute to the Great Recession by enacting legislation such as the Community Reinvestment Act of 1977 that encouraged and enabled banks to make risky loans, and by setting artificially low interest rates. This act gave the opportunity for homeowners that would not have been provided this opportunity due to their financial situations before. With the housing boom in the United States in the early to mid-2000s, mortgage lenders seeking to capitalize on rising home prices are less restrictive in terms of the types of borrowers they approve for loans. Lenders were approving unqualified buyers trying to generate more opportunities for new homeowners trying to spike the economy. However, this led to further issues when these buyers were not able to pay back their loans. This technique then hurt the economy rather than grow the economy at the time. In another attempt to provide homeowners with more opportunities, interest rates were dropped. Interest rates were dropped at 5.25% in September of 2007. By the end of 2008, the Fed had reduced the target interest rate to 0% for the first time in history in hopes of once again encouraging borrowing and, by extension, capital investment. The federal government was searching for ways to make homes more affordable and attainable for potential buyers. However, this strategy backfired and showed the opposite effects, which contributed to the recession. Controversially, during an economic boom, businesses borrow more money to invest in projects that will help meet the stronger demand for their goods and services. The demand for loanable funds will strengthen, putting upward pressure on real interest rates. In turn, the government higher interest rates will make it more expensive to purchase consumer durables and undertake investment projects. Banks needed to readjust after the moves they had made during this recession. Over the short term of the financial crisis of 2008 affected the banking sector by causing banks to lose money on mortgage defaults, interbank lending to freeze, and credit to consumers and businesses to dry up for the much longer term. The financial crisis impacting banking by spawning new regulatory actions internationally throughout Basel III and in the United States through the Dodd-Frank Wall Street Reform and Consumer Protection Act. New actions were needed to help counteract the problems that led to our economy to such turmoil. Government intervention was apparent during these difficult times through the use of monetary and fiscal policies. Several monetary and fiscal policies were utilized leading up to, during, and after the Great Recession in an attempt to stimulate the economy and bring people out of the economic hardships the country was facing. Some of the policies utilized and created consisted of financial stabilization, fiscal stimulus measures, TARP, and American Recovery and Reinsurance Act. Automatic stabilizers like unemployment insurance, the Supplement Nutrition Assistance Program, and Medicaid, in addition to automatic stabilization associated with tax revenue, are particularly valuable. Through the government's utilization of both monetary and fiscal policies are contributing factors to counteract through difficult times in history. In hopes of averting another financial crisis, in December of 2009, the International Basel Committee introduced a set of proposals for new capital and liquidity standards for the global banking sector. The reforms, known as Basel III, were passed by the G20 in November 2010, but the committee left it to the member nations to implement the standards in their own countries. In addition, in the U.S., the Dodd-Frank Act passed in 2010 requires bank holdings companies with more than $50 million in assets to abide by stringent capital and liquidity standards and sets new restrictions on incentive compensation. The government has passed new laws and regulations, has created new opportunities to face economic crisis and struggles that our country can and may face in the future. We want to position our economy in the best possible position to ensure we can continue to strengthen and grow our economy. Recessions can happen at any given time. Therefore, our country needs to ensure they are prepared to face a recession if the situation presents itself. Consequently, policymakers should learn about proposals to help the next recovery start faster, make job creation stronger, and restore confidence to businesses and households so they resume investing and spending again. Enacting these proposals in fully reasoned detail before the next recession strikes will help us to avoid the delays and risk associated with writing stimulus legislation in the middle of a meltdown. The more prepared our country will ensure we recover and get past the recession as effectively and efficiently as possible. To ensure we are prepared as we can be, we should utilize the recessions that had happened in the past, what was helped us out of the recession, to emulate what has worked and develop new strategies for areas that negatively impacted our economy, and then to help it. There are four major goals of economic policy: stable markets, economic prosperity, business development, and protecting unemployment, universal basic income, student loan reform, and to strengthen our fiscal policies will minimize the risk of future recessions. Universal basic income is a program where every citizen receives a flat monthly payment regardless of whether they're working and earning an income or not. This would stimulate the economy by providing people with enough currency to live, be able to have the chance to meet their needs, while also providing enough money to save and spend their currency to help grow the economy. Many of students are coming out with a significant amount of debt from school loans and having difficulty starting up their lives because of this debt that is acquired. This makes it very difficult for a student to help stimulate the economy because they are worried and strapped to pay a high amount in student loans each week. If this problem is not fixed, they could utilize this money. If this was fixed, they could utilize this money towards other areas and put their money towards new ideas and businesses that would stimulate the economy. Strengthening the fiscal policy responses to weakening economy requires more robust automatic stabilizers. The features of tax laws and spending programs like unemployment insurance and the Supplement Nutrition Assistance Program, formerly The food stamp program automatically reduces income losses and support consumer spending in a downturn. In conclusion, recessions happen. It's how a country responds and reacts that makes a country successful. Government intervention through the use of monetary and fiscal policies helps a company get through difficult times in our country's history. Thank you for your time today.